Most people believe stock buybacks are a reward for success. They hear executives say the company is strong, cash reserves are healthy, and returning value to shareholders makes sense. They assume buybacks mean the business is doing well. They imagine this money flowing back into the market in a fair and balanced way. That belief feels logical. It also hides what buybacks are actually designed to do. Because buybacks are not mainly about rewarding long-term shareholders, they are about controlling perception. They are about inflating specific metrics that determine executive pay. And they are about quietly transferring corporate cash to insiders before risk shows up. If you want clear explanations of systems designed to benefit insiders while the public absorbs the cost, subscribe to Insider Expose. This channel exists to explain what corporate language is designed to hide. A stock buyback happens when a company uses its own cash to purchase shares from the open market. Those shares are often retired or held, which reduces the total number of shares outstanding. On paper, each remaining share now represents a larger slice of the company. This sounds neutral. It sounds technical. It sounds harmless. But the real effect of buybacks has very little to do with ownership and everything to do with accounting optics. Most investors focus on earnings per share. Media headlines focus on earnings per share. Executive compensation packages are built around earnings per share. Analysts issue ratings based on earnings per share. Buybacks raise earnings per share even when nothing improves. Revenue can stay flat. Productivity can stall. Long-term growth can weaken. As long as the share count falls, earnings per share rises. This creates the appearance of performance without the substance of performance. Executives understand this perfectly. Executive compensation is heavily stock-based. Bonuses, option grants, restricted shares, and performance awards all move with the stock price. When buybacks lift the price, compensation increases automatically. No innovation is required. No risk is taken. No long-term investment is necessary. Buybacks turn financial engineering into personal wealth. This is why buybacks tend to surge at very specific moments. They increase when executives receive large equity awards. They rise before insider selling windows open. They accelerate during periods when organic growth slows. The timing is not accidental. Buybacks also shift how companies use their cash. Instead of reinvesting profits into workers, equipment, research, or resilience, companies redirect cash into share repurchases. This is not because buybacks are better for the business. It is because buybacks are better for stock-based pay. Workers see stagnant wages, training budgets shrink. Job security weakens. Meanwhile, billions are spent supporting the share price. The company looks successful. The workforce feels the opposite. Buybacks also weaken companies over time. Cash reserves shrink. Balance sheets become more fragile. When unexpected stress arrives, companies lack flexibility. They already spent their surplus boosting stock prices. This pattern repeats across industries. During economic expansions, buybacks explode. Cash flows are strong. Credit is cheap. Executives accelerate repurchases. Stock prices rise. Compensation grows. Then downturns arrive. Suddenly, buybacks stop. Liquidity disappears. Companies that claim strength now claim vulnerability. They cut workers, they freeze wages, they ask for support. By that point, insiders have already sold. Buybacks also distort capital markets at a system level. Instead of rewarding innovation, markets reward manipulation of share counts. Instead of long-term planning, markets reward short-term price movement. Companies learn that shrinking is more profitable than growing. This creates a dangerous feedback loop. Management teams prioritize optics. Boards approve aggressive repurchases. Compensation committees design incentives tied to price targets. Each layer reinforces the same behavior. The system pushes executives toward extraction, not creation. Retail investors rarely benefit in the same way. Most individual investors buy after prices rise. They hold during volatility. They absorb downturns. They do not have access to insider timing or compensation structures. By the time risk appears, the upside has already been captured. Buybacks also increase inequality. Stock ownership is concentrated among institutions and wealthy households. When buybacks lift prices, wealth flows upward. The broader economy sees little benefit. The public sees rising markets and assumes prosperity. In reality, the gains are narrow and uneven. Governments enable this behavior. Regulations allow buybacks with limited restrictions. Tax systems favor capital gains. Political narratives frame buybacks as efficient capital allocation. Buybacks were once considered market manipulation. Restrictions existed. Those restrictions were removed. What followed was predictable. Today, trillions of dollars are spent on buybacks. That money does not build factories. It does not raise wages, does not increase resilience. It inflates prices. Today, trillions of dollars are spent on buybacks across global markets. This is not spare cash sitting idle. This is money generated by workers, customers, and long operating histories. This is capital that could have strengthened companies for the future. Instead, it is used to push stock prices higher in the present. That money does not build factories, does not modernize infrastructure. It does not improve supply chains. It does not raise wages or reduce job insecurity. It does not fund training or protect workers during downturns. It does not make companies more durable. It inflates prices. It creates the appearance of strength without the substance of strength. For a while, this illusion works. Markets respond to higher earnings per share. Analysts upgrade ratings. Headlines celebrate performance. Executives point to the stock chart as proof of success. Compensation increases. Confidence builds. Under the surface, risk accumulates. Cash buffers shrink. Balance sheets become thinner. Companies rely more on debt to fund operations and future buybacks. Financial flexibility declines quietly, quarter by quarter. The system looks stable until it suddenly does not. The risks remain hidden until they are impossible to ignore. They remain invisible during expansions, when credit is cheap and optimism dominates. They only surface when conditions tighten and reality tests the balance sheet. When markets crash, buybacks disappear instantly. Companies that spent years buying shares suddenly stop. The same executives who claimed buybacks were disciplined capital allocation now claim caution is necessary. When liquidity dries up, buybacks vanish. Access to cheap credit closes. Cash that once supported stock prices is no longer available. The artificial demand disappears, and prices fall faster than they rose. When companies face real stress, they reveal how much of their strength was cosmetic. Profits were real, but resilience was not. Growth was reported, but capacity was hollowed out. Stability was assumed, not built. At that moment, the narrative changes. The same companies that insisted markets should be left alone now argue they are too important to fail. They emphasize their role in employment, pensions, credit, and economic stability. They frame their survival as a public necessity. They claim the system must be protected. They warn of cascading consequences if support is not provided. They point to workers, retirees, and communities as justification, even though those groups did not benefit when buybacks were flowing. They asked for public support. By the time this happens, the wealth transfer has already occurred. Executives have collected bonuses. Insiders have sold shares. Shareholders at the top have locked in gains. The downside remains with everyone else. Losses are absorbed socially. Gains were captured privately. Buybacks are not an accident. They are not a misunderstanding of finance. They are a predictable outcome of incentives that reward short-term price movement over long-term performance, and extraction over stability. Executives respond rationally to the system in front of them. Boards approve what markets reward. Investors chase metrics that appear strong. Regulators allow the behavior under the banner of efficiency. The outcome repeats. Once you understand buybacks, many things start to make sense. Why stock prices rise while productivity stalls. Why wages lag while compensation at the top explodes. Why companies appear successful even as long-term investment declines. Explains why executive pay grows regardless of results. Targets are met through financial engineering. Bonuses are triggered by metrics shaped by buybacks. Accountability weakens as optics improve. Explains why companies look strong until the exact moment they break. Strength was measured by price, not by resilience. Success was measured by charts, not by capacity. This is not about a few bad actors making unethical choices. It is about rules that quietly shape behavior across the entire system. When rewards are structured this way, outcomes follow. And as long as buybacks remain one of the fastest and safest ways to inflate insider wealth, the system will continue to reward appearance over reality and short-term extraction over long-term stability.